Okay, well, I'd like to welcome everyone to our webinar today. Thanks so much for joining us. The webinar today is on understanding the biofuels market from 2010 to the present and looking forward to 2030. My name is Mike Centetos. I'm the Policy Director for the National Center for Sustainable Transportation. I'll be moderating the webinar today, and I'm just going to take a quick minute to tell you who we are before we jump into our presentation. This is part of a webinar series sponsored by the National Center for Sustainable Transportation. NCST is part of the University Transportation Centers program that's administered by the U.S. Department of Transportation. We're a consortium of 6 universities from around the country focused on advancing environmentally sustainable transportation through cutting-edge research, direct policy engagement, and education of our future leaders. Our webinar today is going to last 1 hour. We'll have a presentation from Dr. Julie Witcover of the University of California, Davis, and that will be followed by some remarks from our guest respondent, Nick Pavlenko of the International Council on Clean Transportation. After that, we're going to open it up for Q&A. So please feel free to use that Q&A button at the bottom of your Zoom webinar platform to type in your questions. You can type them as we go along, and we will do our best to answer all of them when we get to the Q&A at the end. We will be recording the webinar, and the recording will be available on our website along with the slides in the next few days. So with that, let's jump into our presentation. I'm very happy to introduce Dr. Julie Witcover. She's an assistant project scientist at the UC Davis Institute of Transportation Studies and the Policy Institute for Energy, Environment, and the Economy. She's had a long time focus on low carbon fuel policies in her research. She's the author of a recent NCST white paper examining the market for examining the market for various types of biofuels over the past decade and how current policies might affect the market moving forward. So we'll include the link to that white paper in the chat here in a minute. So Julie, we're very happy to have you with us to share your findings, and I will turn it over to you.
Thank you, Mike, and thanks to everybody who's tuning in. I have been well introduced, so I'll just jump right in with a thank you to the National Center for supporting the research. And here is just a screenshot of the white paper and the policy brief to which Mike alluded, and links, which I think will already be going in the chat. So I'm going to start with telling you where I'm going. And the main takeaways are that in the last decade, alternative fuel policy in the US really wanted to get commercial scale low carbon biofuels from cellulose going, but that really didn't happen. But other biofuels did come in under the policy, notably renewable diesel and biogas. Right now, in the early 2020s, the existing policy really isn't looking sufficient to spark large volume cellulosic fuel by 2030 or even into the low 2030s. And the current winners in the biofuel pool look like they'd be poised to grow given the current policy. Now, there is something new on the landscape. There's electric vehicles. They are moving much more strongly into passenger, and some heavier duty vehicles with a lot of policy support, especially in California. And the more that happens, the less low carbon biofuels should ultimately be needed. But there's still a need for substantial, or expected need for substantial low carbon biofuels, both to lower carbon emissions during the transition and in the longer term for heavy duty uses like long haul trucking, marine, and aviation. We can talk about potential alternatives, but some of them also draw on biomass. And there still is wanting a robust feedstock sourcing protocol that really guarantees that we're getting the kind of benefit from these fuels that we'd like to. And right now, especially with the war in Europe, the food supply and economic investment stability really are also looming large. Okay, so let's review a little bit what the policies were in the 2010s that were aiming to do this. On the national level, we had the Renewable Fuel Standard, the RFS, that set annual volume mandates. That was a nested mandate, and you can see them in that graph right on the left, ramping up over time. And they had carbon intensity reductions embedded into them. Carbon intensity, when I say that, I'm referring to greenhouse gas emissions per unit of energy counted over the entire life cycle of the fuel. So not like greenhouse gas inventories that just look at emissions in the state. This can be production in the Midwest, et cetera, all, or in the jurisdiction, all count. California had a separate policy in the same time frame, the low carbon fuel standard, and it also was based on carbon intensity, but their carbon intensity was really at the forefront, and it sets an annual carbon intensity target that decreases over time. Currently, the 2030 target is for 20% reduction from 2010 levels. Unlike the renewable fuel standard that really is focused on biomass-based fuels, in the low carbon fuel standard, any fuel will do as long as it meets the carbon intensity target. So the expectations in 2010 was that cellulosic ethanol, which would be a low carbon biomass, would play a big role. There were the cellulosic mandates in the RFS, and because RFS fuels would also count for the low carbon fuel standard, it's thought they would do a lot of work for compliance there. But as this slide focuses on, really less than hoped for is an overstatement. If you look at the blue line, that's the cellulosic mandate in the RFS as a statute, and you look at the blue bars, that's the reported cellulosic fuels that showed up through 2020. So the cellulosic statutory levels really far, far exceeded reported volumes. Now, in order to deal with this, EPA, the US EPA, invoked its authority to lower mandates, which it was allowed to do if the fuels didn't show up in the marketplace. But the other thing to know is that even in that small bar, very little of that cellulosic fuel was liquid. And liquid is important, or thought to be important, because it could blend in with petroleum fuels and use existing delivery and fuel infrastructure and vehicles. But instead, that cellulosic fuel came from biogas, which basically came in 2014 under a book and claim system in the RFS, and since then has accounted for more than 95% of the mandate. Now that light blue bar at the very end there shows that cellulosic ethanol did come into the market somewhat in the late 2010s, and that happened in California. But this cellulosic fuel was made from corn fiber that really piggybacks on corn ethanol plants at a relatively low cost. So for that reason, it has limited scalability. But just to note, it is growing very quickly because we went from 54 million gallons in 2019 to 140 million gallons in 2021 in California. So these challenges to the more large-scale cellulosic really emerged pretty early in the decade and then continued. It was a drip, drip, drip of unfortunate news if you were hoping to see this fuel come online. As early as 2013, the economists noted that it was more difficult and costly than expected. In 2016, the Scientific American did a roundup basically recounting these difficulties. And what the difficulties were really a string of announcements where about bankruptcies, firm closures, sales, financial shortfalls, construction's delayed, commissioning delayed, shift in project scope away from biofuels or out of the country altogether. So this was not a rosy industry development picture. Well, why was this? In part, and this was summed up well by Lee Lind, who's at Cornell University in 2017, there were still technical challenges, and the policy itself encouraged the private sector, and the private sector was ready to go big. And he puts this down to an overestimation of technological readiness. Basically, the assumption was that this stuff is ready to go, and so we don't really need to do very much more. And in a way that makes sense because these policies like the RFS and the LCFS create a market pool for fuels that are almost ready to come into the market. That's kind of what we've seen. But R&D, research and development, pretty much bypassed cellulosic ethanol because it was assumed that it was ready. The grants and the loans basically said, hey, go big. We want big volumes because we want the volumes to meet the mandate, and we want to garner scale economies and bring down costs. But as it turned out, because there wasn't a step-by-step growth from a small pilot plant through intermediate plants to sort of prove out what might go wrong, the large scale, once it started to open, did have problems that weren't seen at the smaller level, and feedstock handling was a big part of it. In order to try to fix that, plants were shutting down, additional capital investment was put on, lots of testing, lots of delays, and then commissioning delayed or then not happening. The conversion technology yields didn't show up as expected, and not surprisingly, investor confidence was shaken. But it's not as though the rest of the environment was so great for investment. The court had something to say about both these programs. Early on in the RFS, the court suggested that there was little latitude for the EPA to set the cellulosic mandate beyond what was expected in the market. And that's exactly what you need to create an incentive to create more. So in a way, the EPA was hamstrung by the court to have less pull on the market through its setting of the mandates. California had its own legal challenges. There were challenges to the environmental vetting of the regulation, and it ended up freezing the standard for several years, and kind of called into question for some, is this going to come back online? So the increased stringency of the policy that was built in was delayed. And so if you're an investor, you're saying, hey, this isn't getting any stronger right now, and I'm not really sure it's going to. The rest of the environment wasn't that great either, because there was challenging raising capital after the Great Recession, and the early failures in cellulosic didn't really help. And then you had, it's hard to believe now, but gasoline prices did take a big dive in late 2014. And this means that it was harder for any alternative fuels, including cellulosic, to be competitive. So what you see is an investment dropping off by mid-decade. And it not only dropped off on the bar on the right, you're sort of seeing that the type of investment softens. So instead of grants, you have loan guarantees and that type of thing. So you basically see less enthusiasm reflected in the investment picture. That's not to say the policies did nothing. There were new and unexpected fuels that appeared under these incentives. I'm going to focus on renewable diesel and renewable natural gas. These both emerged as relatively low-cost compliance options. That's the policies are built to basically get compliance at the lowest cost, and this is what showed up. So the market is telling us that they're lower cost. And they both scaled sufficiently and quickly enough to meet these policy targets. So far, I'm just going to spend a few minutes on these fuels, but I think the discussion will go into it in more depth. But renewable diesel really saw remarkable growth in California, in the US, but really driven by California. On the left, you see that rise from nowhere to almost 1 billion gallons. The feedstocks are mostly residual oils that have a lower carbon intensity score because they don't use land. But that other slab that's growing at the end, the sort of peach color, is mostly soy. So that's basically the increased demand is moving the feedstock supply more into the crop area. Now, this has added up to almost a 30% share by volume of renewable diesel in the California diesel pool by the end of last year, which is really a remarkable transformation. Not surprisingly, industry has taken note. The first renewable diesel plant was overseas. Then there were a couple that started here, fairly large volume, and now those have expanded. I've listed some here, and more oil companies are getting into the business of either retrofitting in part or in whole their refineries in order to produce renewable diesel. So you see really a lot of announced capacity for the next few years. one of the really interesting developments is that the oil companies are also moving more into this, taking over the existing companies, buying out REG and Renewable Energy Group, which was a big player in this space, and also getting more directly into feedstock supply, because really the question is, where is all the feedstock going to come from? And there are fears that, or concerns, or thoughts that this is a challenge to really meet this much capacity, and it may not all come online. But as we've seen, when the residual oils run out, the next up is soybean oil. And so there is a signal that soybean oil will be used more in this build out. The other fuel that really has been surprising is renewable natural gas, which we've already seen is the main RFS cellulosic fuel and pretty much drives the setting of that mandate. In California, now the volumes here are not super large compared to renewable diesel. And at least initially, there's sort of a natural break of the size of the natural gas fleet. But this fuel really also took off, and you can see it here in the left, and it almost displaced fossil natural gas by 2020. California, like the RFS, has a book and claim system that really helps this along. So if you put renewable natural gas into a pipeline in North America and then have a paper contract for fueling in California, you will get the ability to benefit from the incentive. Okay, let's get back to cellulosic biofuels. Where are we now? Well, they're still expensive. We're still waiting that convincing winner, or in terms of, one conversion technology really looks like it's going to be much less expensive and more successful than the others, or a successful commercial debut. There was a review last year by Cargbo et al. That kind of summarized where these technologies are, both in terms of cost and greenhouse gas emissions. And while Fischer-Tropsch's conversion, gasification, looks like the most ready to go, and indeed comprises most commercial activity, it really isn't a clear winner yet. And there is work being done on these other fuels too. And it's still about twice as expensive as fossil fuel. My colleague, Robert Williams, and I did a study a couple of years ago that's highlighted on the right, that just basically, I really want you to focus on the wide ranges in these literature techno-economic reviews. So they basically say that there is no clear winner here, and feedstock is a big part of the cost, and there's not as much you can do about that if you're looking for ways to reduce costs. One of the things we found that was interesting is that the estimated costs in the literature actually were going up over time, and we think that's because as these commercial challenges emerged, basically there was more of an idea of what might be causing them, and they could be built into the techno-economic analysis more successfully. So what are the prospects? Like I just said, there isn't a clear winning commercial technology, although Fischer-Tropsch seems to be having the edge as an early mover. One thing I hadn't mentioned is that really the focus has moved off in the commercial space from off on-road to sustainable aviation fuel. First of all, there's a thought that we're going to need a low carbon biofuel there for longer, but the actors also better aligned for market deployment. You have governments involved, defense, you have airlines that are interested in lowering their carbon footprint, and the NGO community has been more involved in trying to ensure that the feedstocks are not coming from food sources, are less dependent on land, et cetera. But that said, we're still awaiting the first full commercial facility. Fulcrum has a facility in Nevada using municipal solid waste that is has been delayed, but is still moving. But the larger point is, even if that is successful, proving out that this technology does work, and building out additional facilities will take time. And these things together is, even in the rosiest scenario, you're not going to be getting large volumes in the next decade or so. I don't want to leave the impression that nothing's been going on, though. There has been a lot of research activity. Research and development really has shifted in response and focuses more on the feedstock, looks at the complete supply chain and integrated processes. So basically looks at all the parts of the system where something might go wrong. The end uses have also broadened to include a wide array of bioproducts and co-products, basically understanding that you're going to need a full range of portfolio of products in order to have commercial success. Another area for examination is, where does the processing take place? Because feedstock is really hard to move around. Do you want to do all the processing at the centralized biorefinery, or do you want to distribute some of it? So all of these are very active areas of research. Another sign of the maturing of the techno-economic analysis with information from the market is that you've definitely moved from the best design abstracts that, as I mentioned before, incorporate these learnings, but also have more sophisticated uncertainty analysis on policy incentives, on other market prices. But the bottom line is that current policies are really not expected to be a big driver of cellulosic fuels right now. As I've underlined, fuels that are already existing in the marketplace are really enough to meet the compliance targets without a substantial policy shift. The discussion, especially in California, really, but also nationally, sort of gets to this: how much electric vehicles will roll out, and then how much biofuel, and in this case, renewable diesel as a low-cost option, will be needed to scale up to meet the targets. I have a couple of pictures here from a couple of studies. The first one on the left I was involved in, and it basically said, hey, let's say we don't have a super robust EV rollout, not negligible, but kind of at the low end of the projections before the more ambitious targets were announced. You're going to need a lot more renewable diesel. Here it was on the order of 75% blends. Another study by California's Clean Future for next gen basically also looked at, what if you have a really successful electric vehicle rollout? Well, then that's the yellow bar stack in that graph on the right. You're not going to need as much renewable diesel, which is hydrotreated vegetable oil, the light blue. So there's this trade-off, and as we've seen, because of the robust growth of biogas, that really may change this picture and make less renewable diesel needed if it continues to be a big growth area. I just wanted to give you a sense for the size of the incentives that we're talking about. In the last few years, renewable diesel, at least from the residual oils, has been, over $1.50 per gallon in an incentive from the LCFS alone. For renewable natural gas, most of the sources have about $1 or a little bit less, or a little bit more, I should say. But dairy digester or basically manure digester renewable natural gas has a much stronger incentive because it has a very negative carbon intensity due to assumptions of captured methane. Petroleum fuels are incurring a cost, which here shows as a negative number in this graphic. And you see in 2021, it reached about 25 cents a gallon. So this is not nothing. In California, the fuels that have come online have also altered the policy landscape, even with the existing policies. So on the left, you see how the LCFS credit prices have moved over time and into this year. This is already turned down even more than is shown here. But some of this is thought to be because of the prospect of more renewable diesel announcements and a lot of different pathways coming on with very negative carbon intensity from manure biogas. So much so that last month in the scoping plan update, the California Air Resources Board that administers the program basically signaled that they were willing to change the 2030 targets, not only set targets beyond that, but change the 2030 targets in California to be more stringent. And that might send a signal to the market to stem the credit price decline. Now, at some point, if the credit price gets low enough, that incentive goes down and you're not going to get as much renewable diesel and biogas. But the overall picture is that the marketplace is telling us that these fuels are the low-cost options that that will come online when policy incentivizes low carbon fuel demand, whether it's California or anywhere else. Now, the road from here, this is a bit of a summary slide. As I've mentioned, most people think biofuels and biomass more generally will still be needed down the road for energy in the transportation system, especially for heavy duty uses like some trucking, shipping, and aviation. But there's more opposition now, not only on the land use side, that has always been a challenge, but on the grounds of tailpipe and production emissions. So if we're really going to go to zero emissions, this does not do zero emissions as it stands now. There are other alternatives like hydrogen and electrofuel from low carbon sources, but they are still also extremely expensive, whereas some of this stuff is really ready to go. In terms of sourcing, there's still a lot of debate about the land use impacts, and they've changed. It's not like nothing has happened. There's more retrospective analysis in the mix, but it really has not come to any kind of conclusion. And this has left policy at a bit of a crossroads, trying to figure out how do we handle this challenge of land use. My own view is that there's still lacking a reliable protocol to get feedstock sourcing the way you want it in order to really avoid or mitigate these societal harms. And it's more important in this food versus fuel charged environment that we're on now. What I would submit is that the substance, the feedstock itself, is it corn, is it this, is it that, is less important than the context from which the feedstock is taken for market impacts. So there is some work focusing on that, and it's very administratively unwieldy, but I really feel like sooner or later that's what we're going to be looking at. Action Now could guide appropriate supply and moving forward. And really, as the land sector hopefully is brought into the carbon picture, biofuels really need to be part of that picture, because there's nothing really special about biomass for biofuels, except that the policies themselves are asking more about greenhouse gas emissions. In terms of technology development, I've mentioned that sustainable aviation fuel is really now the proving ground, and there are a range of stakeholders that are putting in investment attention. This is happening more in Europe, but really significant cost reductions have to wait for more build out. In terms of the policy, these policies, the RFS and the LCFS, really are built to push deployment of real near-ready technologies, and we've seen that's what they've done so far. More targeted policy would be required to move research and development into the commercial realm. EU has blending targets. We can have more of a policy discussion during the panel. And that's all I have. Thank you so much for your attention, and back to you, Mike.
Thank you so much, Julie. Really appreciate it. Just a reminder to folks to go ahead and use the Q&A box to put your questions in, and we'll get to those soon. Before we do that, though, I want to introduce our guest respondent, who we're very lucky to have today. Nick Pavlenko is the Fuels Team Lead for the International Council on Clean Transportation, which is an international nonprofit organization focused on providing unbiased research and technical and scientific analysis on a wide variety of areas in transportation in support of environmental regulators. Nick is also focused on alternative fuels policy. And Nick, we're really interested to hear about some of the related work that your team is doing, and maybe how your findings align or not with what Julie just presented. So Nick, I'll turn it over to you.
Definitely. Hello, everybody. It's a real pleasure to be joining you for the discussion today. I'm just going to provide a few very brief remarks and a few slides to accompany Julie's terrific main presentation today before we jump into the Q&A and the discussion. So here I'm going to talk about a few of the high-level takeaways from the last decade of biofuel policy in California, discuss some of the implications for national level fuels policy, and highlight a few areas for improvement. Next slide, please. So first things first, relative to the expectations in 2010, the deployment of second generation biofuels has largely been a failure. I don't think there's necessarily a single overriding factor behind all this, but rather, as you heard before, it's a more nuanced combination of a set of technical, economic, and political barriers. And it's clear on paper, at least, that the incentives for fuels like cellulosic ethanol are quite high. You can see in the chart on the right, there's a RIN, there's a higher LCFS credit value, and sometimes, depending on the year, even a tax credit for producing second generation biofuels. And together with the actual market value of supplying the energy, these can greatly exceed the market value of producing something like corn ethanol. So what happened? In practice, these incentives failed to directly mitigate the specific risks and barriers of advanced fuel production. Many projects had really high upfront costs, could take years to design, construct, and scale up, and had a project lifetime of 10 or 15 years when they did manage to get up and running to even break even. And market-based systems like the LCFS and the RFS had fluctuating credit values, and in some cases, long-term policy uncertainty. And tax credits, which could just appear one year and disappear the next, are even less valuable when looking out into the future. And so investors, rightfully so, typically discounted the value of these incentives when assessing the viability of a project. Now, in contrast, first generation fuels like corn ethanol, biodiesel, even renewable diesel may be worth less on paper than an advanced biofuel, but are a sure thing. They got lower upfront costs, can be built relatively quickly, and they have a stable market. But some first-gen biofuels like corn ethanol and soy do have some blending constraints and have relatively higher carbon intensities. So what then hits the sweet spot in current fuel policy? Next slide, please. Enter renewable diesel. When made from waste oils, it has a carbon intensity and LCFS value very similar to cellulosic biofuels with a few of the downsides. And as you saw in the previous presentation, the LCFS has done a really good job of driving the growth of renewable diesel in California, as you can see in the chart on the right. Now, whereas California consumes relatively little soy biodiesel today, it's grown to use most of the rest of the country's waste oils, as well as driven the import of some waste oils from abroad. Now, California comprises about half the domestic biomass-based diesel market, and that share is actually likely to keep growing. And we're at an interesting juncture. Nobody's going to produce additional used cooking oil and fry more food due to biofuel demand. And increased collection of waste oils is likely expensive and very challenging. Increasing imports from Asia pushes up against foreign demand for waste oils. The EU has got its own biofuel policy problems, and it also risks palm oil fraud, where virgin vegetable oil can be substituted as waste oil, which has already been documented in a few cases in Europe. And instead, just to keep up with the LCFS-driven demand for renewable diesel, California is likely to double down on soy and begin blending greater quantities of domestic soy to fuel its incoming renewable diesel capacity expansions. Now, if that soy is coming from other states' own biomass-based diesel consumption, that leads us to question the net impact of the LCFS. And if it's derived from increased domestic soy crushing or even land expansion, it risks unintended sustainability consequences on the vegetable oil market. A root cause here, why are we going backwards to soy biodiesel when we already were blending waste oils, is that the structure of the LCFS incentivizes additional proven soy production, even though it has a higher carbon intensity than some of the riskier advanced biofuel pathways. Next slide, please. And a similar trend we've observed in recent years has been the growth of biogas. California uses book and claim accounting, meaning that any project in the country can theoretically qualify for LCFS credits when it injects biomass into its own gas grid. Recently, for example, I even saw a landfill in New York State touting its local efforts to fight climate change, even as the biogas it injected into the New York State gas grid was nevertheless being credited under the California LCFS. Though in reality, the mix of gas in California is dominated by fossil natural gas, book and claim accounting is used to have a higher share of biogas in the California transport mix effectively. And as you can see here, advance the slide, please. The quantity of credits from biogas has exploded in recent years, and it's one of the factors contributing to the recent decline in LCFS credit prices. In particular, the dairy biogas contribution has skyrocketed, even as it remains a relatively low quantity of fuel in absolute terms. That's because the carbon accounting for dairy biogas, which assumes that the methane is captured and turned into fuel, would have been emitted into the atmosphere. Therefore, each unit of dairy biogas is effectively bundled with a sizable carbon offset, often making these fuels highly carbon negative and giving them some of the highest LCFS values in the program. So while there's actually very little diesel being replaced, there's now a lot of LCFS compliance from a relatively small amount of fuels. Now, the question now is, how accurately does this reflect reality? With California's recent methane regulations in place, there are now outside requirements to reduce methane emissions on farms. Behavior to capture methane or manage manure in different ways is not necessarily entirely attributable to the LCFS, prompting further analysis of what the actual counterfactual behavior is and what the true LCA value of dairy manure or biogas could be. Changing its carbon intensity in the program just by taking a different LCA approach can really change the value of dairy biogas and its effects on how the LCFS compliance. Next slide, please. So lastly, I want to contextualize this in the national conversation. So the federal renewable fuel standard statutory volumes only run through 2022. And after that, EPA can then administer the program with a lot more discretion on how high to set volume mandates. This can be politically unpalatable to many different sides of the aisle, and has prompted a lot of questions about the future of the RFS, and has also raised interest in a national low carbon fuel standard based on California's approach, with the idea that with so many people unhappy about the RFS, maybe taking a proven program from California may be an improvement. However, I think it's really important, given what we've talked about today, to question if this is necessarily the right approach. So based on the last decade in California, it's really likely if we just take the existing California LCFS and just transplant it to the national level, it's just going to turbocharge a lot of the existing trends we've observed without necessarily offering solutions to the bigger structural problems associated with the slow deployment of advanced ultra-low carbon fuels. So to explore this question, ICCT did a modeling study published this spring, which used an economic optimization model to assess a variety of scenarios for how a national low carbon fuel standard could be deployed. And we examined the effects on fuel volumes and GHG reductions out to 2035. And you can see the results from our different scenario analyses in the chart on the right. The key things I want to draw out for you are food-based biofuel consumption increase in the gray bar, waste oil biofuel consumption increase in the yellow bar, and the net indirect land use change emissions indicated by the green arrow. So we found that in most cases, the program would just continue the status quo, raising demand for waste oil imports, and then transitioning to a big increase in soy renewable diesel. For most of the scenarios in the chart here, you can see that food and waste oil consumption increases by a lot. We found a mild electric vehicle response, which instead was primarily driven by outside declines in EV prices and complementary incentives like EV mandates and rebates. And then to kind of shake loose from the trend we observed in most scenarios, we also looked at a few safeguard scenarios. And you can see that one of the most effective design decisions to make in a national low carbon fuel standard was a cap on the contribution of waste oils and food crops at 2020 levels, which left more room in the program for advanced fuels with lower emissions, which we found were otherwise crowded out in scenarios 1 through 6. Next slide, please. So to close, I'd like to summarize a few of ICCT's findings from our modeling study and tie them to a retrospective of the last decade. First, and this isn't really a necessarily surprising or profound observation, but it bears saying, the technology neutral performance standard has a lot of valuable elements, but is overall failing at driving advanced technologies. Flexibility and market-based structure drives short-termism with fuels, and some of the advanced pathways require long-term markets and policy stability are getting crowded out. And to mitigate this, we don't need to necessarily toss aside the idea of an LCFS entirely, but we can look to the EU for some ideas. So a recent proposed revision to the EU-wide Renewable Energy Directive pairs a GHG performance target like the LCFS with technology-specific sub-targets for advanced fuels and electrofuels, as well as a cap on food and feed crops. So this pairs the valuable elements of incentivizing ongoing improvement, proportionally accrediting fuels based on their GHG reductions with strong, stable signals for new technologies. In California, an initial step to incorporate this approach could be to introduce a lipid cap, as the recent AB 32 scoping plan sort of hints at. This could cap the use of lipids like soy and waste oils at today's levels, while leaving room in the program for alternatives with fewer sustainability risks. Another revision to the LCFS to investigate is whether to reevaluate or phase out some of those negative carbon intensity biogas pathways. A true up of the LCA values of these pathways to reflect a new updated counterfactual for manure management and methane capture could align them more with the actual quantity of fossil fuels that they displace and with parallel efforts to reduce methane emissions in other sectors. So I want to leave a lot of room for discussion. So thanks for listening, and I'm looking forward to the next part of the webinar. Thanks.
Great, thanks so much, Nick. So we're gonna dive right into the questions. We've gotten some really good ones already. Thanks for those of you that submitted, and others, if you'd like to submit questions, go ahead and type those into the Q&A box. So for the first one, maybe we'll go back to Julie. I think one of the last things that you said was you felt there was a need, or there was a gap in terms of having a reliable protocol for kind of identifying and safeguarding against environmental harms from biofuels. Could you talk a little bit more, and I'll open this up to both of you, but maybe Julie, you can start, what you think would need to be done to accomplish that, and whether there are policies in place either here or abroad that might be kind of a good starting point for that.
Yeah, well, what I meant with the feedstock sourcing comment is that policies tend to single out substances like crop and crops like palm and corn ethanol has a cap in the RFS. And I'm not saying that that necessarily needs to be done away with, but the focus on the feedstock instead of the market context is really important. And what Nick was saying about the residual oils really goes to that point. So it's not like those are in the marketplace without the capacity to have something else substitute for them. So you have these knock-on effects. Now, what you'd really want to look for is, are you sourcing this from an area, from a source that is somehow shielded from large market impacts? A lot of things that are thought of as wastes, you could use them without really hurting the market. But the thing is, when you scale up wastes, they start to have value, and then you start to have the knock-on effects. So it's a really tricky question. Another element of this is, there are degraded lands that could really benefit from crops that would sequester carbon there. But the policies are too broad brushstroke in order to zero down on that level of granularity to really make sure that that's where it's going to happen. You're going to get the benefit. There's work that's been done in Europe that's called the Low Indirect Impact Protocol and module that tries to look at this sort of thing. Would double cropping, take less pressure, take more pressure off the market? I don't want to say that any of that is a panacea, because really the counterfactual for indirect land use change and biofuels is what would have happened anyway. So you have a market that's really demanding more food, demanding more land. So it's not going to be easy to carve something out and say you're not creating additional pressure. But I really feel like those types of situations are where more focus should occur, and basically try to steer that way and see what we have in terms of biomass, how it scales up, and that way be a little bit more secure that it's not going to jump out of the bounds. I think with biomass, because of these issues, you're always going to have this specter of, oh, we've gone too far, and so investors have to understand that, and it's just, I don't think it's going to go away completely. Hope that answered.
Nick, did you want to add anything? Or?
Yeah, definitely. So I think that for mitigating against some of these knock-on effects of biomass demand, an indirect land use change assessment as was done in California, is a nice start. It can give us a sense of the climate risk associated with some biofuel policies, additional protections such as sustainability criteria, monitoring, reporting, and verification to assess the supply chain of the biofuels is helpful. But ultimately, something like the ILEC factor incorporated in the LCFS has not necessarily done enough to stem the increase in some of those risky biofuels. It just kind of prices in that risk into their value in the program. What would be more effective could be a cap or a phase out of some of the pathways that analyses suggest are more risky, such as has been done in the EU.
Great. Thanks to you both. So we got another question specifically about renewable diesel, and you both kind of touched on the current viability of that fuel and kind of this expected pretty dramatic expansion. Could either of you or both of you talk more specifically about that fuel and kind of how to identify warning signs that feedstock sourcing for that fuel is getting problematic, I guess, for lack of a better word?
I can start. I guess, I mean, to me, last year we saw, okay, so feedstock prices have been going up. You had a big increase in soy prices, not just from this, because there's, big activity globally and in China. But what we saw that was more unusual is that the soybean oil price sort of decoupled from its normal relationship with soy, and instead of being much considerably lower, moved towards parity with the bean. Now, if that's robust, that's a warning sign to me, because it starts to signal it has more of a chance of changing farming decisions. Now, on the ground, it's true that under the RFS there was a lot more corn and some soy got pushed out. So some of this might end up, increasing corn-soy rotations. But this is something that a market analysis would need to look at. I have no idea what the impacts would be. With the oils, you always have palm on the margin, palm oil, which we know as it's currently cultivated has really big indirect land use change or direct land use change implications. So yeah, I mean, to me, looking at the price signals is a warning sign. How you then course correct when that's happened. I mean, it's that's not a. I mean, the price signal, yeah, is going to mean there's more action sooner. But how would you dynamically affect the market? I don't have good ideas for that.
Yeah, thanks, Nick. If you want to weigh in, feel free as well. Otherwise, I'll move on to the next question. I think a lot of these questions and your responses are really getting at a lot of the complexities in this market. We've got a couple questions about low carbon fuel standards being adopted in other states beyond California. So maybe we'll start with one of those, which is, what, if any, effect would you see some of those new standards going into effect? What impacts might those have on feedstock availability and production nationwide or around the world?
Yeah, I mean, I think all told, if you look at not just the LCFS programs, there's a big signal, because Europe also has its own programs. For the LCFS programs themselves, the way it currently is, Washington State coming online, it will make a difference, but it's not huge. So California is really a big player. Canada's coming online as well. But that's a bit of more of a question mark, because it has more opportunities in its program for upstream petroleum production to create credits. So what the biofuel signal ends up being is unclear. And even if the entire market were online, it would basically be, it's more on tune with California. So potentially big, but not unclear how much. But the larger picture is this is going to keep happening. And so, and depending, not all of these jurisdictions have land use change as a prominent policy component. And so you really know from the market that these are low cost and that more policies, either low carbon fuel standards or something else, are going to come online, and these are really ready to go.
I'll also jump in here on this one. I think the advent of a lot of these West Coast low carbon fuel standards will have similar effects as California's. Of course, the markets are smaller, as Julia said, but at the end of the day, it is another player entering the market that can drive up the cost of lipids necessary for the long-term compliance of that policy structure. Canada is a little bit more interesting just because so many of the proposed aspects of the policy do facilitate a lot of upstream emissions reductions from fossil fuel infrastructure. Some would say that actually dilutes the efficacy of the policy, but for the purposes of our discussion here, it does mean less pressure to produce biofuels. But in Canada in particular, they are concerned about the existing domestic renewable diesel capacity and are concerned about the extent to which Canada would need to source renewable diesel from the US to comply with the CFS.
Well, maybe on the flip side, looking at some of these new programs coming online as an opportunity, I'm curious what you both have seen so far in terms of kind of how much they align with each other, or maybe is there an opportunity we've missed, or we could still take advantage of in terms of standardizing methods for calculating carbon intensity and indirect land use change, some of those things that you've touched on. So maybe you both could talk about kind of what you've seen so far and what you might hope for with future programs coming online.
Yeah, I mean, the programs do jointly send a bigger signal for more low carbon fuels. So it definitely has that impact of strengthening the market signal. On the West Coast, there's a Pacific Coast Collaborative Agreement among British Columbia, Washington, Oregon, and California. And part of that focuses on the clean fuels to try to create a regional market. And there is some alignment on general principles, although basically as these programs get tailored to their jurisdictions, there are particular things that jurisdiction wants to see. Not all the carbon intensity ratings are exactly the same. So you're going to have these differences, which are it's very confusing on the one hand for the producer. On the other hand, I would also say they started at different times with similar targets. So you might have a very stringent target in California and less of one in Oregon. So while that's kind of a nightmare if you're a producer trying to navigate this, it also creates some opportunity that a fuel that may lose its market in California could gain a market somewhere else that isn't as far along. So if you're thinking about investment and where the stuff is going to go, it kind of creates a more complicated ecosystem of areas. Because of the way that the carbon intensity gets tailored to the jurisdiction, I think there's some alignment on general principles that's possible, but I don't see it aligning completely without a program that's instituted at a national level, for example.
Great, thank you. There's a question, Nick, you mentioned in your presentation, RINs, Renewable Identification Numbers, I think is what that acronym is for. So the question is about what the outlook is for electric RINs and what feedstocks could be eligible. So yeah, I'll pass that over to you.
Definitely. So yeah, it's been rumored that sometime this summer, even EPA will have an eRIN rule coming out. And so what this would do would, after a lot of pushing from the industry, allow electric vehicles to play a role in the RFS for the first time. But the effectiveness of this rule change is likely to be very limited. So for example, due to the definitions of renewable energy in the RFS, it would only be open to biomass energy, no wind and solar, and in all likelihood, it would be biogas producers contributing biogas to electric vehicles. But in terms of the actual impact on eRINs, on renewable energy supply to transportation and uptake of electric vehicles, there's still a lot of big questions and legal uncertainties on how to implement eRINs. So I'm really looking forward to reading the rule when it comes out. So for example, most biofuel pathways in the RFS actually attribute RINs and their value to biofuel producers. And so a big question then is, how do you link the program then to electric vehicle deployment? There's not necessarily a mechanism in place yet to split or divert the value generated by biogas producers, the likeliest parties to benefit from eRINs, to EV deployment. And also there needs to be a system in place to determine the equivalence value, because a RIN is based on a unit of ethanol consumed in an internal combustion engine, whereas EVs have much more efficient engines, and therefore that unit of energy gets you more kilometers per megajoule. And then kind of on a more bigger level, one thing that came up in our research on the LCFS and fuels policies to support electrification more generally, we found that these policies, like in California, aren't necessarily doing that much to incentivize EV uptake. That's being driven by outside things like mandates and rebates. But LCFS credits can be a really valuable source of revenue to fund those rebates and develop income to support electrification in the long term. So expanding LCFS to credit charging, EV charging infrastructure can still be an important tool.
I would just supplement that to say, yeah, there's some of that going on in the LCFS right now in California. A lot of the electricity credit value gets plowed back into on the hood rebates. The other, and it has that equivalence value taken account of that Nick was mentioning. But the other thing that's, more germane to our point about fuels is that now, California can use that biogas to charge electric vehicles and get credited for it. So there are various places beyond the natural gas fleet that biogas has a way to enter into the LCFS. And so it kind of removes that natural cap of how much of this can we expect to see. The other element that's kind of a nuance is that, to Nick's true-up point, is that as soon as regulations come in that regulate methane in the state, then that really very negative carbon intensity for manure digesters looks more like the other renewable natural gas moving forward for new pathways. But there is a long ramp down for existing pathways. I think that's why we're seeing a lot, like kind of a gold rush right now, in case there is regulation to get more manure pathways certified and lock in that really low CI.
Great. So probably time for one last question, just sticking with that nexus between electric vehicles and fuels. Is Julie, you presented on, you talked about this trade-off between renewable diesel and electric vehicles, and if you have more electric vehicle deployment, then maybe less renewable diesel is going to be needed. Could you talk about whether that's in the light duty versus heavy duty space? Like, are we talking about renewable diesel playing a role in the light duty vehicle market, or
yeah, no, we're not. I should have mentioned this, that because in the LCFS, compliance can be fungible across fuel pools. So if you generate a lot of credits, whether it's substituting for gasoline or diesel, it's pretty much treated the same way by the program. So if you generate credits on the gasoline side with EVs, it's going to mean there's less credits necessary to be garnered on the diesel side. That said, and those graphs I showed and those studies really did focus on passenger battery electric vehicles, but with the new regulations in place, there is the expectation that the electric vehicles will be moving beyond that and be substituting for diesel more than they already are in the next decade.
Gotcha. Okay, thank you. Well, so we did pretty good on questions. We got few we didn't get to, so my apologies to folks that submitted those that we didn't get to. But I do just really want to give a big thank you to you, Julie, for presenting your research, and Nick for presenting your work, and to everyone who attended today. So thank you so much. I did just want to say that you'll get a quick survey at the end of the webinar for you to share your thoughts on today's presentation. So we would appreciate if you could fill that out for us. And with that, we will adjourn, and just thank you all once again for participating.